This video is intended for educational and informational purposes only and does not constitute tax, legal, or financial advice.
Hello everyone, this is John. Today I want to talk about a subject that surprises many retirees: paying taxes on Social Security benefits. Most people think that once they start collecting Social Security, that money is theirs tax-free. But the truth is, depending on your income, up to 85% of those benefits can be taxable. The good news is that there are smart planning strategies to help reduce or even avoid those taxes, and that's what I'll explain today. Social Security benefits have been taxable since the mid-1980s, and the income limits used to decide whether your benefits are taxed have not been updated for decades. That means more and more retirees are finding themselves paying tax on a portion of their benefits. For example, if you are single and your combined income is below $25,000, your Social Security is not taxed at all. But once your income rises into the $25,000 to $34,000 range, for up to half of your benefits may be taxable. And if your combined income is above $34,000, as much as 85% can be taxed. For married couples filing jointly, the breakpoints are a little higher. But the story is the same. Once you cross those thresholds, more of your benefits are pulled into the taxable column. So how do you keep more of what you've earned? The key is lowering what the IRS calls provisional income. Provisional income includes not just your adjusted gross income, but also tax-exempt interest, like the kind you earn from municipal bonds, plus half of your Social Security benefits. The higher this provisional income number, the more of your benefits end up taxable. If you can manage that number carefully, you can keep more of your benefits tax-free. One of the first strategies is to pay close attention to interest and dividend income. If you're holding a lot of certificates of deposit or other taxable investments, the interest they produce counts directly against you. Imagine you have $200,000 in CDs, earning 3% interest. That's $6,000 added to provisional income every year, which could make your Social Security taxable. But if you place that same $200,000 in an annuity where the interest is reinvested, the income grows tax-deferred and does not appear on your tax return until you actually withdraw it. That difference alone could keep more of your benefits free of tax. Another important move is deciding where to place your assets. Interest and dividend-paying investments belong inside retirement accounts like IRAs, where the income is shielded until you take withdrawals. On the other hand, growth stocks, which don't generate much annual taxable income, can sit in a regular brokerage account without hurting your tax picture until you sell them. By shifting the type of assets you hold in each type of account, you can lower taxable income without lowering your actual standard of living. Withdrawal strategy also matters. Every dollar you take from a traditional IRA or 401k shows up as taxable income. That not only increases your adjusted gross income, but also makes more of your Social Security taxable if you don't need the money. Sometimes it's better to minimize these withdrawals. Roth IRAs, by contrast, are incredibly valuable because qualified withdrawals are tax-free, and Roth IRAs don't require minimum distributions. That means you can tap Roth funds when you want to manage your taxable income carefully. However, because of the advantage that withdrawals form a Roth IRA are not subject to tax, many people, including myself, recommend minimizing withdrawals from a Roth IRA. If you still have business or partnership income, maximizing deductions and legitimate expenses helps keep taxable income down, which also lowers the portion of Social Security subject to tax. And if you invest in the stock market, remember that tax loss harvesting is a valuable tool. Selling an investment at a loss allows you to offset capital gains, or if losses exceed gains, deduct up to $3,000 against ordinary income each year. That reduces your adjusted gross income and helps keep Social Security benefits sheltered. Another approach is simply delaying Social Security benefits. While you can claim as early as 62, waiting until age 70 increases your benefit check each year. This not only boosts your income in later years, but may also reduce taxable income in your early retirement years if you're relying on other assets instead. Delaying can be an especially powerful move for married couples planning for long-term financial security. Roth conversions are also worth considering. By converting money from a traditional IRA into a Roth IRA, you pay the taxes today, but the funds grow tax-free and are not subject to required minimum distributions. Over time, this move can reduce your adjusted gross income in retirement, which means less of your Social Security is exposed to tax. While you do take a tax hit in the year of conversion, the long-term benefits can be significant. Beyond managing investment income, you can also think about the overall efficiency of your portfolio. Tax-advantaged accounts are the foundation of a smart strategy. Traditional retirement accounts like 401ks and IRAs give you upfront tax deductions and defer taxes until withdrawal. Roth accounts work the opposite way, no deduction upfront, but tax-free growth and withdrawals. Health savings accounts are another powerful tool, offering a triple tax advantage if you're eligible to contribute. Even 529 plans can be helpful if you're saving for education expenses for your family, allowing growth and withdrawals free from tax. Even within a taxable brokerage account, you can choose tax-friendly investments. Municipal bonds often pay interest that is exempt from federal tax, though keep in mind that this interest still counts when calculating whether your Social Security is taxable. Index funds and ETFs usually generate fewer taxable capital gains compared to actively managed funds, which helps you minimize your tax bill. Holding individual stocks long-term also means you qualify for the lower long-term capital gains tax rates instead of the higher short-term rates. Asset location is another subtle but effective strategy. By placing tax-inefficient assets like bonds or actively managed funds inside IRAs, and putting tax-efficient assets like municipal bonds or ETFs in taxable accounts, you maximize tax savings. The assets with the highest growth potential, such as aggressive stock funds, often belong inside Roth IRAs, where the eventual withdrawals will be tax-free. Of course, if you don't want to keep multiple investment accounts and would prefer to consolidate everything into one, it's definitely recommended that you manage it through a tax-advantaged account. Finally, let's talk about one of the most powerful tools for lowering adjusted gross income in retirement: the Qualified Charitable Distribution, or QCD. If you are age 70 and a half or older, you can donate up to $108,000 directly from your IRA to a qualified charity each year. The best part is that this transfer counts toward your required minimum distribution, but is not treated as taxable income. That means your adjusted gross income stays lower, which protects your Social Security from taxation, and may also prevent you from being pushed into higher brackets or losing valuable tax credits and deductions. For married couples, each spouse can give up to $108,000 for a combined total of $216,000. To qualify, the money must go directly from the IRA custodian to the charity, and it has to be completed by year-end. While you don't get a charitable deduction for a QCD, you don't need it because you've already reduced taxable income by keeping the distribution off your return in the first place. Reducing taxes on Social Security benefits isn't about just one tactic. It's about layering strategies that together keep your adjusted gross income in the right range and protect your retirement income from unnecessary taxes. By combining tax-efficient investments, thoughtful withdrawal planning, and charitable giving through QCDs, you can significantly reduce the portion of your Social Security benefits that get taxed. And remember, it's not just about minimizing taxes for 1 year. These strategies are designed to keep more money in your pocket throughout your entire retirement. If you found this helpful, make sure to like and subscribe for more practical tax and retirement planning tips. And as always, consult with a qualified tax professional before making decisions, because every situation is unique